You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, we have made it through earnings season and we're getting to the end of the year. So I want to look at some strategies that I have not always addressed inside Options Playbook Radio. And these strategies are more basic strategies, probably more highly used strategies, actually. The two strategies that I'm talking about are just covered call writing, and then a derivative of that, which is called a collar, which is the combination of selling a covered call and then taking the proceeds to buy a protective put. So you're combining covered call writing with protective put buying. And these are some interesting strategies. And so as always on Options Playbook Radio, nothing is meant to be a recommendation. We're just looking at interesting times to do specific strategies, right? And just in general, especially the way the market has been recently, a lot of people have been fleeing for protection, right? We have the VIX index just doesn't seem like it can get below, or it's just hovering around the 20% level. It's been hanging there for months and months. But then again, October is known as a volatile month, and sometimes even November is considered one of the more volatile months in the marketplace. So we are going to look at some strategies on, and specifically I'm going to talk about a FANG stock. We're going to talk about Apple here. Apple has had some bad news recently. A lot of people have a lot of capital gains in it. And here's the way I like to approach my portfolio as I'm approaching this, the year end. You need to do some cleanup, right? You have some capital gains that you might have to take in the new year, or you want to take in the new year or put off to the new year. And then you have some losses that you might want to take in this year. So those are the two different scenarios. So the biggest thing that I like to do right now, specifically in the middle of November, is look at what stocks would I not mind selling. Either I've been down on them for a while, and I don't want the cheese anymore. Just let me out of the trap situation. I just need to get off the horse and sell the actual stock. And then I'm going to look at a couple of them that I might have had some decent gains in that I've held for a while, but now I'm a little nervous. And I think Apple really falls into this little, I don't know, gray area. A lot of people probably have some decent capital gains in Apple, but Apple has just got beaten up lately, and maybe you just want to put off those gains until the next year. So I'm just looking at different scenarios where these type of strategies will apply. And since we don't have a lot of time on Options Playbook Radio, I'm just going to stick with one particular stock. And in this instance, it's going to be Apple. So in this scenario, we have Apple today. We're taping Options Playbook Radio. It is the 14th of November. It is a Wednesday. The market has closed. Apple has 2 down days in a row. Right now it's trading at 186 $1.80. It was down $5.43. So the first scenario would be, well, I don't mind selling Apple if the stock continues up higher, right? I've just had some downtime. I might sell it if it continues higher. Or I've lost some money on Apple and I just want to sell it and occur the loss in this year. Okay, those are two different scenarios. Now, if I was looking to do that, we need to sell something that's going to expire before the year end. And the normal monthly expiration in Apple is December 21st. That's the third Friday of the month. So let's just stick with that expiration. That's obviously before year end. And what I would look to do, the stock is at 186.80. Implied volatilities have been high on Apple, relative, mainly because it's been down and people are nervous. So this is a great opportunity to go on out and try to sell some premium. I want to get rid of the stock, so I'm going to look at either selling an at-the-money option contract or as close to at the money as possible, or just out of the money. And I'll let you decide how bad you want to sell Apple. But in this scenario, we own 100 shares of Apple. We've owned it for a while. Either we got a capital gain or we have a capital loss that we're looking to trade on. And if we sell the Apple 190 call with 37 days to expiration, we can actually bring in on the bid $6 total for just selling the right to sell our 100 shares at 190. The actual ask price right now is $6.20. So we might do a little better than $6, but we're getting that much premium. It's trading at about a 30% implied volatility now, that one particular strike for that expiration. Now, if you're a little bit more serious about selling it, a lot of times I'd like to go just a little bit in the money. And in this instance, we have a 185 strike call, and I could go out and sell that option contract for $8.50. So you're bringing $8.50 worth of premium in, and that's saying I just want Apple to stay where it's at, or if it continues higher, and I'm going to get 185 for that. So I'm giving up some intrinsic value in this scenario, but I'm bringing in $8.50. Now that's on the bid price. Now the ask price is $8.75 right now. So I'm giving you true bid prices based off of the market quotes. But we got to realize 185 with the stock at 186.80 means that we have $1.80 of intrinsic value that we're giving up here. So $1.80 minus that $8.50 is $6.70. So if we go down from the 190 level, right? We go down from the 190 level strike down to the 185 strike, the maximum benefit to us as far as premium is concerned is $6.70 versus $6. So there's only a 70-cent difference in premium, but still that's a lot of premium on an underlying stock like Apple if you happen to own 100 shares of it. So just a thought to put in your head. If I want to do something before year end in Apple, either I could have a loss because I've recently bought it and Apple's gotten beaten up, or I just want to get out and have a tax occurrence before the end of the year. And I don't really talk about, never give tax advice on Options Playbook Radio. So it's specific to your situation. You want to talk to your tax advisor on what you might want to do. The trade then is just a simple covered call on the stocks that you own. Now, what recently I've had more people reach out to me and ask about how can I protect some of these FANG stocks and what's going on. And the answer is, well, let's look at a collar, but instead of staying in the December expiration, well, now we want to go out to the January expiration. Why are we going out to the January expiration? Well, we want some protection to help us get out to the next tax year. We've seen Apple down about 10 points over the last couple of days, and now we want to protect to make sure that we can get into the next year to maybe put off some taxable capital gains, right? In that scenario. And once again, it depends on your scenario, but Apple is a widely held stock. It's probably one of the most widely held stocks inside Ally Invest. So how would we do this? Well, we've already kind of talked about the covered call writing, right? And we're seeing that we're bringing in a lot of premium in this scenario. So if I'm trying to put off a gain or just protect myself out into the next year, I'm going to go a little bit further out of the money. And my whole goal here is to just sell enough premium in Apple to help pay for the protection, to help pay for the put on the opposite side. So we've been down about 10 points already. If I'm comfortable, if that number is where I want to just stop it at, what I'd probably do is go with Apple at 186.80. I'd be looking at buying the 180 put. I'm going to stop the bleeding right there. Now, that's an expensive put if we go out to the January 18th, the normal monthly expiration in January. That's 65 days away. That option contract on the bid is $5.95. On the ask is $6.30. And I will remind you that we're taping Options Playbook Radio on Wednesday, the 14th of December, and the markets are closed. So, with that said, now I want to go to the call side and I want to find something that will help pay for that protection. And you're not going to get too far out of the money, but you get a little bit of bang for your buck. You're going to get a little bit more upside than you do on the downside. But I can go in and sell the 195 call in the same expiration, and that's bidding 605 and asking $6.30. So if I do this trade where I'm buying one and I'm selling one, I can get this done for a small net credit to the account. Right now, the midpoint net credit would be 8 cents on that trade. And that means that we went out and we bought the 180 put just over 6 points below that marketplace. And we've sold the 195 call, and the 195 call is about 9 points above. So we have a little bit more upside than we do on the downside, but yet we're still able to get this trade done and pull in a net credit to the account. This is called a collar. So we're collaring the stock price. We're saying if the stock goes up above 195, go ahead, take it away from me. I don't need any more gains above and beyond that. That's fine by me. We pushed out our capital gain till the January 2018. If the stock goes down and it goes below 180, guess what? I can still push out that gain. I don't have to exercise until January 18th, but I'm taking my ball and going home. I'm not playing anymore. Anywhere below 180, I can just exercise my put and sell a stock. So now there's a different scenario. The last scenario is, what about if it's right in between? What if it's between 180 and 195? Well, that's fine. You just owned Apple. And you can decide to just sell the stock outright after the options expire if you'd like to. Or if you want to get out, let's say January 1st comes and you just want to get out of everything. Well, you can buy to close the call, sell to close the put, and go on out and sell the stock outright. That's always an alternative in the options trading market. All right. So a few basic trades that we can look at going into the year's end. Nice way to kind of clean up your portfolio, bring in a little bit of income. I think covered calls is a great scenario on stocks that you just want to get out of your portfolio before the new year comes. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.